Brian, thanks very much. After cutting interest rates by a quarter point for the first time in months, most Fed officials agreed it was appropriate to ease further beyond that cut that they gave. Some were a little bit more cautious, and we'll talk about that in a second with a big debate there. And those who were cautious citing financial conditions, which were pretty robust, and upside inflation risk remaining elevated. The Fed cut amid what the minutes called a shifting balance of risks at the time. Downside risk to employment had increased. Inflation risk had either diminished somewhat or had not increased. A few argued they could be either unchanged on rates or they could cut. They could go either way, essentially. They were concerned about the stalled inflation progress and inflation expectations. There was a range of views and apparently an interesting debate on just how restrictive the Federal Reserve was at the time, or is even now, and that's reflected, I think, in markets. Participants stressed the need for a balanced approach in addressing the employment and inflation sides of the mandate, arguing that they would address that side of the mandate that was further from their goal. Stephen Myron, as you know, dissented. He had noted, as he has publicly since then, saying that the neutral rate has fallen. He thought the Fed was more restrictive because of that. Quick detail on the inflation bit. You had those saying, look, productivity is going to keep inflation down. You have lower net migration. That would put downward pressure on inflation. And employment was not a source of inflation. On the other hand, those who were more concerned about inflation talked about tariffs. They talked about inflation expectations remaining elevated, and businesses saying that they would raise prices to pass along some of those tariff increases. Most thought the tariff effects would be realized, get this, by the end of next year, not this year, but the end of next year. And there was a line there, Brian, I thought was interesting. They are watching artificial intelligence, talking about the huge impact it's having on GDP and investment, and also noting the adoption has the potential to reduce employment. Brian?
So all in all, Steve, is it fair to say that the bias was, you said there were some people who are having trouble making a decision whether they want to lower rates or kind of keep them the same. Is that kind of a tell or a read, some sort of tea leaf to what we can expect at future meetings?
If I could answer that, Brian, I would say, normally I would say it depends on the data, but we don't have the data. So we have to go back to where they were back then and think about the data they may be seeing. I think the important phrase here is the one that I led with, that most thought at the time when they did it, it was appropriate to ease further. I think the debate is not does the Fed ease or not, Brian. I think they will. It's how much from here. And that's why I stress this issue of this debate over how restrictive the Federal Reserve is. Some think the Fed is very restrictive. Stephen Myron's taking out his point that the neutral rate is much lower. And if the neutral rate is lower, then the Fed being up here is more restrictive than thought. Others look at the financial conditions, the booming stock market, relatively stable interest rates, and say, you know what? There's not a whole lot out there in the markets or even in the economy that's screaming. So there's a debate, but I would say the bias is towards rate cuts. The unknown is how much.